All right. All right. So welcome to Traders Consigliere trading course. So this is week 1, class 1. And today we'll be looking over trading view features and the overview. What are time frame candle representations, trading sessions, and the type of trading styles. So we start with the basics. So trading view features and overview. So first of all, you need to understand what trading view is. Trading view is a powerful and comprehensive technical analysis platform for traders and analysts. It is the go-to tool for conducting in-depth technical analysis, providing an extensive range of charting and analytical capabilities to help users make informed trading decisions. So what you need to understand about TradingView is, just like an artist who has a canvas, TradingView is our canvas. This is where we express our thoughts, emotions, and then we spectate to see if it makes sense, right? So that's how you got to view TradingView with. And it's extremely important to us as traders to be using TradingView platform. This is where we do our analysis. Yep. We don't place our trades on TradingView. We do our analysis here. So I have put a link down here. If you hit that link, it's a referral link. It'll help you get a discount on TradingView packages. But for now, you do not need it because as a beginner, use the free version. That's enough, right? So time frame candlestick representations. So before we go to there, I want to go over TradingView, show you how I have set it up and what everything means before you get to the next topic. So on the left here, we have all our tools, right? So we are retail traders. We don't have tools as institutions or hedge funds have, right? So the tools that we use, these are the common tools, right? So what I do is I highlight those, I favorite them. The reason why is the ones that I use often, I highlight those. The reason why is because at the bottom, if you see here, it's always available for me to use, right? So these are the tools that I've highlighted. So if you refer to the video back, you can highlight those same tools, right? My Fibonacci retracement tool. These are the tools that I like to use from time to time. The text box, price note, the head and shoulders pattern. Obviously your long position and your short positions, and the price ranges, right? So these are what I like to do. Once I do this, if you have, this is, by the way, this is the desktop app. So I do suggest you download the desktop app. It's a bit cleaner to use. So what I do is once I have done that, I switch off the drawing panel. So I have a bit more room on the screen, right? So on the top here, what do we see? So we have all our instruments, right? So our instruments are, there are a bunch of different instruments, right? So we can trade any kind of instruments from forex, commodities, stocks, indices, right? So for example, on my screen right here on the top, we have gold, forex, right? So let me show you how, wait, hold on. Let me switch on the trading panel there. Where is it? All right, so one thing, before we get to, let's get to the symbols first. So on the symbols, this is where you search your pairs, what kind of pairs you want to trade with. So for example, I trade British pound, Japanese yen. And personally, if you type British pound, Japanese yen, you see how many brokers are available to trade with. Me personally, I use Oanda charts. And the reason why is that just for the technical aspect of it, it has the least gaps in the market, and it has and it's very accurate spreads. So if you do not know what spreads are and gaps are, that's completely fine. We will be going into that as well in the middle part of the course, right? So for now, whatever instrument that you trade, use Oanda charts if possible. So that's your symbols. You search your symbols up here. And right here is the most important part as well. These are your time frames. So we have multiple different time frames here, and these are the time frames I personally use. So I have favorited those so I can quickly access them right on the top. So you can copy those, and I'll get into why what are these time frames used for and what do they mean. Then obviously we use candlestick charts and there are different type of charts. So I only use candlestick charts, so I've highlighted that. Your indicators, you have there are a lot of indicators that you can use. These are few of them that I have highlighted. I don't use indicators anymore because I'm a bit of a purist with price action. I like straight price action. What else do we have? Yeah, your indicator template, you can save them up here, so you can quickly get into it. Your alerts, right? Your alerts is here on the top and also on the right there. So you can put an alert. So as traders, we don't want to be on the charts all day. When you set your alerts, it alerts you to come back to the chart and look at the market and see what's happened and place your trades. So alerts are quite important and an extremely important tool to be using. And then you have your replay button right there on the top. Replay button is back testing. So what happens with this is, for example, you have your strategy down, you understand the market. Now you want to back test your strategy to see if it works, to see what is the percentage of win rate that you have, right? So this tool right there, you can rewind the market basically. And for example, you want to take a buy there, you can just test out how the market performs according to your strategy. So you're just beginners at the moment, so you don't have to worry about this, but good to know, right? So what else do we have? You can save your layouts, obviously, all your layouts right there and access them. And one thing would be important once we get down to the journaling section of the course. On the top right, you see that camera icon right there. You can copy the images and you can journal them. So for example, you took a trade, before the trade, you took a photo of the trade in certain time frames. And after the trade, you took another screenshot to see how the trade played out. And then, so that's quite useful to be using. What else do we have on the right? On the top here, on the right, this is essentially what's called a watch list. So on the watch list, you have all of the pairs that you trade, so you can have easy access to them. For example, if you see the pair that's open at the moment, it's British pound, Japanese yen. If you hit the second pair right there, that's British pound, US dollar. So you can access them really quickly on the right. And also another advantage could be you can look at the price, because once you become really intimate with your pairs, you understand exactly at what price the pair is at. So if you do know, you get so tuned in with the market, you understand the prices and you can quickly access them. So we have that. This is I don't use those. What else is there? So I would say those are the most important ones. You have an order panel here. This is only used if your broker integrates with TradingView. But the way it works, the lot sizes, which is basically the leverage, me personally, I do not use it because I'm a bit more familiar with MetaTrader 4 or 5, which we will get to also in the middle of the course, so you don't have to worry about that. And this is the last icon right there. This is what is essentially called an order book. You don't really need this, right? If you're really someone who trades heavy volume, few $1 million, maybe it would make more sense to be looking at this. Then at the bottom, you have your stock screener. Let me extend this. This is basically, in a way, like the watch list, but for stocks. You have your Pine editor. Pine editor, you don't need to use. This is for people who use trading bots. So they code their own bots and they integrate it with TradingView. Strategy tester is basically you can test that strategy with the bot. And your trading panel. These are the brokers which integrate with TradingView. So the brokers that I personally use, they do not integrate with TradingView. These brokers are usually regulated brokers. So we will get into what a regulated broker is and what are unregulated brokers in the end of the towards the end of the course. So don't have to worry about this. So I'm just giving you an idea what that means. So that's TradingView. Especially once you actually make your account and you see your charts are just different color. So hit right click, hit settings, and change the colors to your liking. So me personally, I have these colors set, right? these settings. Let me show you. Yep, these settings are the ones I use. I use purple as for the bullish candles and the gray for the bearish candles. And we'll get into the psychology of the colors of the candles as well later in the course. So that's trading view for you. So let's look at the next topic. So time frame candle representation. So I just showed you a different time frames. So what does each time frame really mean? And why are they even used, right? So the monthly candle represents the overall buyers and sellers pressure for that particular month. Vice versa, the weekly candle also represents the buying and selling pressure for that previous week. So does the daily candle and the H4. And I'll show you exactly what I mean. Let me flip into a different pair. Let's say oil, maybe. Let me actually pick up another one. All right. So the monthly candle, what does the monthly candle mean? And what does it represent? So if you look at this candle right here, the previous candle, not the current forming candle of this month, June, the previous month on May, if you notice the candle, this candle is a representation of what happened during the month of May, the buying pressure and the sellers pressure in the market. So this is the conclusion that they came to when the market closed in May, right? So if you, let me see if I can do that, if I can highlight this. So let me, so if you look at this candle right there, that's the month of May. So this represents 4 weeks of a month, right? There's 4 weeks in a month. So if I zoom out, one second, I think the visibility of the candle is right there. So this represents 4 weeks. So if you look at the date right at the bottom of the screen, you see that's 1st of May, that candle right there, 2nd week of May, 3rd week, and the 4th week. So these 4 candles right here represent the month of May, right? So if you each candle basically represents those time frames. So for example, the weekly candle, right? Let's take this week. If you go down to the lower time frame, you'll notice the week starts on Monday, right? So Monday, Tuesday, Wednesday, Thursday, Friday. So this week candle closes right there. So we have 5 days in a week when it comes to the Forex, commodities, indices, stock market, not with the crypto market. With crypto market, you have 7 days in a week and it's open 24/7. So these markets are usually closed in the weekend on Saturday and Sunday. So that's why 5 days represent 1 week, one candle. So that's what that represents. And if you even want to, that's what these timeframes represent. Every time frame you drop, it basically shows you more details, right? So if you go to the 4-hour candle, for example, the 4-hour candle basically shows you a representation of the last 4 hours, right? What happened in that. So the reason why we do use all these time frames is to analyze. We do not take a certain bias from just one time frame. We just don't use one. We use all the time frames to truly understand the clearer picture. Because a monthly candle can tell me something, but when I go down to a 4-hour candle, that tells me a different picture. So I have to formulate my own bias, because at the end, trading is all about probabilities. We do not have any guarantees in the market. We trade with probabilities. So you have to go down and look into all these timeframes to formulate your own bias, and then form a picture on where and why you should be taking the trade. But we will get into that later down in the course. You don't have to worry about these candles at the moment. Just know what they mean. All right. So trading sessions. Now that you understand which trading platform to use and what those candles also mean, you now need to understand what trading sessions are. So we have the Forex market. I could add even the Forex, the commodities, or the indices market, or even the stock market. They are open only 24 hours, 5 days a week. So Saturday, Sundays, the markets are closed. Crypto market is open 24/7. So the sessions, there are three major sessions that take place every day. You have your London session, your New York session, and your Tokyo or Asian session. We call it Asian session usually. The time that I've mentioned here is according to my time. This is actually the time that I've mentioned here is according to the winter when the daylight actually goes back. For me at the moment, it's 11 p.m. to 8 p.m. So you have to understand which trading sessions to be trading at if you're based according to your schedule, because sometimes these trading sessions can end up happening in the middle of the night when you're sleeping, right? So it's not feasible for you to wake up in the middle of the night to trade. So you need to pick up a session which makes sense for you to trade, and I would suggest either London or New York, or even both if you can. And one thing to obviously keep in mind is the daylight savings. It moves the sessions 1 hour back in summer, and obviously it moves it 1 hour forward during October and November, something to keep an eye on. So let me show you the trading sessions before we go further. So I have a tool here called Sonar Lab. Let me see if it works with this. Wait, let me use another pair. So for example, if you do see this, this tool shows me the start of a session and an end of a session, right? So for example, on Asian session that you see right there on the top, the Asian session in my time zone starts at 4 a.m. and ends at 11 a.m. And at 11 a.m., London session starts. So 11 a.m. is completely feasible for me to trade, right? Maybe you do a full-time job, maybe 11 a.m. may not make sense, right? So you have to pick up the session that makes sense. For example, New York, for me, in my time zone, starts at 4 p.m., right? But what do you notice happen? The London session and the New York session are overlapping because the London session starts here and it closes at 8 p.m., right? So these few hours in the middle right there, we see an overlap of London and New York. And I'll show you what that exactly means. So yeah, London and New York session overlap between 5 p.m. and 9 p.m. in my time, pretty much. During this period, both sessions are active in the market. So what that means is the London traders and the New York traders are trading at this time. So what results is there's a heavy increase in volume in the market. By volume, that means there is a lot of money in the market. Because when there's a lot of money in the market, when the traders are the most active, we have the most volatility, right? And what does volatility mean? The movement in the market, how fast it moves up or down, and does it trend well? So what happens is with volatility, that gives us a lot of opportunities to enter and exit trade positions, right? Very simple. So pip movement. So you don't have to really understand what pip is. We'll get into that in the next few classes. But what pip essentially means is just like a car, or leave a car. For example, there's a distance, right? We can measure distance in kilometers or miles. So we understand from the point A to point B, this is how much distance it is. Just like that, pips also is a unit of measurement when it comes to the trading market, right? So we use pips to understand how much price move from point A to point B. And what this chart here represents is during London session and New York session, we have the highest pip movement, right? There's a lot of volume. So price move from distance A to distance B a lot. And that essentially means is we can make a lot more money when price moves a great deal. And if you do notice, the Tokyo session, the Asian session has the lowest pip moment. So that means that trading the Asian session wouldn't be the most, won't give us the most opportunities. Sure, it can give us some opportunities, but not the most. The highest probable opportunities come during London or New York session. So you need to understand, why do trading sessions even matter, right? So I've got into a few of them. So the London trading session is widely recognized as the most active and the volatile in the foreign exchange market, the forex market. And especially during the overlapping session of London and New York, we have the highest liquidity. Again, liquidity means money, a lot of money in the market. And what happens is, because of that high liquidity in the market, that results in low transaction costs and commissions. So low transaction costs and commissions, don't worry about it. We're gonna again get into that in later down in the course if you don't understand. Also, additionally, you need to know is it's common to observe a decrease in volume following the close of London sessions on Fridays. So the mentality that 9 to 5 workers usually have, for example, before the weekend on Fridays, they like to go home early, right? They want to start off their weekends a bit early. Just like that mentality leaks into the market as well. So on Fridays, especially when London session closes, even though the New York session is still open, a lot of traders like to take their profits, right? And they want to go home, call it a day. So what happens here is, when a lot of London sessions traders take off early, even maybe New York traders, it reduces the volume in the market. That means there's less money in the market, right? What happens when there's less money in the market? There's less volatility. That means you can take only, you won't have the most best trades to take, right? So something to keep in mind when you're trading, right? The timings of when you trade and it matters a lot. So you have to keep in mind when to trade. So you need to understand, where does the volume actually come from? So the main volume that comes in from the Forex market, especially, and the indices or even the stocks, it comes from central bank institutions and retail traders. Retail traders are people like us, right? We are retail traders. But the whales, the ones who have the most amount of money, they are the central banks and institutions. So you need to understand that it's very important to note that while retail traders may not significantly influence the Forex market, given its immense market capitalization, that means the Forex market actually is, I think, if I'm not mistaken, maybe 20 times bigger than the NASDAQ market. So people like us, with our money, even if you have a few $1 million, that's nothing. It's a feather in the Forex market. So that barely moves the market. The people who actually do move the market are people such as the central banks and the institutions who trade billions of dollars, right? So they are the ones who move the market. But in markets where the capitalization, the money in the market is a bit low, right? Like the crypto market. In those markets, possibly you might see retail traders have a bit more control in how price moves. You might have, notice the articles and videos of people dumping money into a certain crypto coin, and it ends up rallying like crazy and then dumps like crazy. The reason why is there's a lot of less money in that market, right? And people are, in fact, even picking an instrument which has even lower liquidity, meaning less money. So when there's less money in the market, the retail traders can tend to move it. But the market, especially that we trade, at least I trade, my money wouldn't even be a drop in the ocean, right? So, yep, I have mentioned as well, again, observe the volume. Basically, the amount of traders who take off after the London session closes on Friday. And make sure to keep that in account, maybe not even take trades at the end of the Friday, right? And another noteworthy point is, during holiday periods, just like how the 9 to 5 people do work, they have holidays during summers on July and August. And usually, especially August, in my experience, the volume drops to the market. That means a lot of traders take off, they go on vacations. So what happens during summer months? The market tends to not give you as much opportunities, because for us to make money, we need market to go up or down, not sideways. And also December. So in December, you have Thanksgiving, Christmas. So you have a lot of traders take off during December as well. So those are the months I try to avoid trading as much as possible. So that's important. So types of trading styles. This is just a rough idea about the type of trading styles. You don't have to get worried about the terminology and what it means at the moment. You're going to understand that at the end of the course. This is just for a rough idea. So we have 3 types of traders. We have a scalper, a day trader, and a swing trader. A scalper is someone who spends every single day trading, right? So this person right here trades smaller time frames, such as the 1 minute M1 all the way to the 30-minute. They trade a lot of positions, right? Place many trades a day, and their trades also last few minutes, right? So that's the reason why they take trades every single day, and they focus on win rate percentage. What that means is they like to be right most of the time when they're taking their trades. The reason why is they do not have risk reward, and risk reward is it's a concept that we're going to learn deeper into the course. Just for a nutshell, risk reward means every time they risk $100, they're looking to make another $100, right? So that means their win rate has to be much higher than the typical trader. And the reason, and they take a lot of positions, right? So what that means is they use smaller lot size. What that means is, instead of me risking $100 in a trade as a day trader, they might be risking maybe $10, maybe $20, because they take a lot of positions. And their win rate has to be much higher than me, right? So day trader is me personally. I'm a day trader. And I personally like to focus. I've mentioned just a very brief thing, but I like to use all time frames, from all the way from the 1 minute all the way to the monthly. But a lot of day traders do like to use the 30-minute to the weekly time frame for a rough idea. And the trade positions can last from minutes to a few hours. And sometimes some positions are not held overnight. That's what a definition of a day trader is. But sometimes it so happens that you may hold a position overnight, right? So we like to maybe place maximum 2 or 3 trades a day if your trade setup is valid. We like to focus on risk reward instead of the win rate percentage. So we flip it. We don't want to be right all the time, right? We can't be right all the time. Even with being 30% or 50% right in the market, you can still be profitable if you focus on risk reward. Risk reward is something we'll get into deeper. So basically, again, as a scalper focused on $100 to make another $100, we risk $100, but we end up making $300 or maybe $500 or even $1,000, right? So we can afford to be wrong sometimes. So again, the next trader is a swing trader. And this type of trader likes to focus from the 4-hour time frame towards the monthly time frame. And swing traders have a lot of different type of swing trading styles, but usually their trades last from few days to up to weeks. And their positions are obviously held overnight because they're swinging the trade. They're holding the trade for a few days. They like to place maximum few trades a month because they're taking positions which are being held over a few days to weeks. So they can't take more positions, right? Because as day traders, we close it off the same day or the next day, but they hold trades. And again, just like the day trader, the swing trader likes to focus on risk to reward instead of their win rate percentage. And they like to use obviously medium to higher lot size. The reason why I did mention medium to higher is because we don't have to be right all the time, but we take few trades. So therefore, if you take few trades, you would like to maybe risk a little more. So don't worry about risk management, what risk to reward means, what exactly timeframes I should be using. There's no worries. We're going to get into all of that deeper into the course. You'll exactly understand what kind of trader you are from your own psychology, the predicaments, such as if you have a job, maybe you have kids to raise, it could be anything, right? So just knowing your own psychology and your own predicaments of your own life, you'll understand what kind of trader you are towards the end of the course, right? So no worries. Don't worry about these terminologies at the moment. So for now, as this is the first class, we'll end it here.